Investors Chronicle.
It's Thursday, the 13th of June. It's the Companies and Markets Show coming to you from the ICFT studios as per usual. We will start today with some heavy metal, specifically gold and copper, the price of which has been heading north for the most part this year. Alex Halma has written a cover feature on the topic, and he is here to give his thoughts on how best to tap into this renewed interest and whether indeed this interest can continue given copper has retraced somewhat over the past few weeks. This week, of course, marks just 3 weeks until the UK general election. Manifestos are being published left, right and centre. So we're also going to talk to our economics writer, Hermione Taylor, about what the major parties' commitments may mean for both the nation's finances and our personal finances. To wrap things up, we will look at the company that sits atop the FTSE All-Share leaderboard this morning. That's safety equipment manufacturer Halma. 45 years of dividend rises are now in the bag, and it's delivering on the growth front as well. Mark Robinson will be along to look at the company's latest full-year results. It's commodities to kick us off, though. We'll start with some context, Alex. As both you and Hermione have written this week, let's talk about gold. It's fair to say the rise in the price this year isn't quite following the script. What's been the drivers as far as we can make out?
It's been an interesting year so far for gold because our traditional drivers of price, interest rates, strength of the US dollar, have said it should be fairly flat, but it's hit new record highs. And the driver, as far as everyone I spoke to for this cover story said, was buying in China, which was layered on top of existing central bank buying, which has come down a little bit given the cost at the moment. But it's basically Chinese investors who want somewhere to put their hard-earned money, and they've moved away from equities, and the real estate market there is bit of a shambles at the moment. So gold has been a major beneficiary of this. And we've seen people spending as much as $100 an ounce in premium above what we would usually see as the gold price to get their hands on it. So that pushed it up quite highly. We've seen fairly strong buying elsewhere in Asia. India buying has been maintained as well. In Europe, it's been quite flat. You've got, say, people in Germany who are selling into the high prices. Elsewhere, there is there's that profit taking, but also people are staying out of it because of the prices. And so there is an idea now. Obviously, I spoke to people who had a fair interest in gold, so there weren't too many bears around at the moment. But the idea was that as these traditional price drivers kick in, so say when interest rates start to come down, people will come into the market then as well. So then you might have more people in the Western Hemisphere buying. And so the idea is that the price floor of gold right now is anywhere from $1,800 US an ounce to even above 2,000, which is what one fund manager put to me.
Also, they will hope. We'll come back to gold in a moment. Let's quickly talk about copper, because for years we've heard about its role in the energy transition and supply shortages. The combination of those two things will drive up demand, drive up the price. That hadn't really happened in the past couple of years until recently. As I say, there has been a cooling in the last few weeks, but what have the dynamics been there?
To give some context, copper has traded between around $6,000 a tonne. Just over 6,000 is the usual $3 a pound mark for anyone who speaks that language. And then at times in the past 2 or 3 years, we have gotten close or even a little bit above $10,000 a tonne. The copper price surged above that and even above $11,000 in recent months as the market flipped from quite a lot of oversupply this year into undersupply, and that became as tonnage from South America mostly. Forecast tonnage didn't reach the market, and this is what people in the industry who've been forecasting quite strong copper prices for a long time almost dismissively called the entrance point of speculators and tourists into the market, who for a lot of them, this might be hedge funds in the US, for example, saw that this was a turning point for the red metal and it was going to keep climbing and climbing. Whereas the reality was this was a momentary point of tightness in the market. And what we see in China, which is such a huge buyer of copper, like so many other commodities, is that there is a fair bit of weakness there. And that momentary supply mismatch was not going to last the whole year. So since then, the price has come off. Also, a bit of, I guess, realism is probably injected into the market where we probably have enough copper this year, but even the experienced investors who called, I guess, a top on that rise in April, May, they're quite optimistic of demand climbing into the second half of the decade and us seeing potentially new highs in copper. But I think the talk of the $20,000 a tonne, $30,000 a tonne made those kind of, I guess, more experienced copper investors laugh a bit.
From what I've seen, the price was sort of hovering around the 8,000 mark rather than 6,000 the last couple of years. Is that fair? Is that what you were saying?
Yeah, I mean, just talking about the range there, and I think as mining costs have gone up, it has settled. Most mining companies will talk about their, being in the first or second cost quartile, but often they will need, say, above 6,000 to break even, and then we have had 8,000 a bit more often. But zooming a bit out, that's kind of the 6 to 9 range.
Let's talk about some specific investments. We'll start with copper, because one other reason arguably for some of the renewed interest over the spring was the BHP approach for Anglo, which really crystallized in people's minds the demand for the metal. That said, as you write in the piece, notwithstanding what might happen to the copper price in future and whether it's done or going to be range bound for a little while, it is quite hard to find good copper opportunities at the moment in terms of shares because they're relatively richly valued. Is that fair?
Yeah, I would say priced in is the way most experienced investors would put it. The examples for that I used were Antofagasta, really sizable London listed copper miner, which has been around a long time and is kind of the main pure play copper option, trading at 27 times forward earnings. And that's the same as Freeport-McMoRan, which is a US major copper miner, which it has huge levels of production. And it was actually that kind of the Freeport size that BHP would have launched itself into if it could have taken over the copper mines that Anglo has. BHP has the world's biggest copper mine. It's still an enormous player in this space without this deal going through. But one of the drivers, and this obviously played into the price rises, one of the drivers for the Anglo deal was just lining up a few more mines with longer reserves into this potential super cycle later in the decade and into the 2030s. I think one analyst made the point that for the deal to work for BHP, they were asking Anglo to scrape off the South African assets before this happened, but they had promised to put a fair bit of money into that, so paying the various tax bills and some of the splitting off costs. So the copper price that would need to be a long-term average copper price that would need to make this deal work, somewhere around $11,500, which is a fair bit higher than most of the consensus long-term copper forecasts. So I think, yeah, as you say, that was a driver of this frothy market as well. And there is a real concern there. I mean, you look at the pipeline of projects coming on, and there's a real need to get into jurisdictions where a lot of investors and companies are less comfortable. So, we've got DRC. There's a huge project that's been built there by Robert Friedland called Kamoa-Kakula, which is a really big contributor of new supply, half owned by the Chinese now, or since a few years ago. There's projects that are probably second-tier projects that are getting a bit more interest now, but it's one of those situations where the industry cut back on exploration spending a decade ago, and that is having consequences now. There's also the permitting risk. One of the supply issues that I mentioned before came from the shutdown of the Cobre Panama mine, which was largely down to community anger over the mine's existence. And that is obviously a situation where the mine was built, but government's anxious to avoid that kind of pushback from communities, so they're being much more careful around permitting. And that's, in many ways, that's a really positive thing. You don't want people to be forced into living next to a giant mine or relocated against their will. But the reality of that is a reduction in supply. The Rio Tinto and BHP jointly own a project in Arizona called Resolution Copper, and because of local opposition that's facing some challenges, that alone, so it's an underground deposit. They've already built, I think it could be up to a 2 kilometre deep shaft. So it's a really, really significant project with quite difficult to access deposit, but they've built that already. That I think would supply 20% of the US's copper demand annually. So these are pretty sizable projects that aren't getting built, basically.
Let's turn back to some of the more simple investment options briefly. There is a copper ETF, the odd one out there. There are, of course, gold ETFs as well, which are clearly the most straightforward way to capture the price rises. But let's move on to the gold miners, because in times of plenty, the idea is that they should be outperforming on the upside. That hasn't really happened in a lot of cases. We do go into a variety of options in the piece. Can we talk a bit about some of them and some of the prospects there and what to watch for?
To be clear, these are equities that benefit from safe haven investment in gold, because that can partly drive the gold price up. But these are not safe haven investments. These are almost the opposite of that. Yeah, I guess the excitement around them, I think, is that they will outrun the gold price. And part of the reason for that is the past few years we've seen rapid cost inflation at these operations, same as everywhere else. Their labour costs, fuel costs, all those kind of costs have gone up. That inflation has slowed, and that combined with the much higher gold price this year means that their profits are going to shoot up. And fund manager I spoke to, so once again, kind of talking his book, but he said you would normally see appreciation in the equities about double what you would see in the gold price. And that hasn't happened yet. And so his line was that gold stocks in many ways are cheaper than they were in February before this part of the current price run started. And I think London has a few interesting options. We've obviously got the largest producer in Endeavour, which is trading fairly weakly compared to others, especially across the pond, because of the drama surrounding the chief executive's departure at the start of the year. It also operates in fairly high-risk areas in West Africa. They've shifted a little bit, so the risk is reduced from Burkina Faso, for example. But it's still, for example, Agnico Eagle, which is a US and Canadian listed producer that has mines in what you would consider safer jurisdictions. Well, there are safer jurisdictions like Finland, Canada, Australia. That's up 27% this year, as opposed to, 1-2%. On the mid-cap side, there's some interesting opportunities where there's a handful of operators that have one mine. So that's increasing operational risk, but also they're trading at under 10 times versus 20 to 25 times. They are valued on that. But I think some of the companies I pick out, Sentiment we've covered a lot, have been fairly bullish on. Hochschild has been the strongest performer this year because it opened a new lower cost mine in Brazil, which is really impressive. They're still at a fairly cheap PE ratio if you're going by that, and their earnings are going to ramp up again into next year. And then on the smaller cap side, in the piece I've laid out a few companies that are about to expand. So they've already got the basis of a producing asset, which will keep their balance sheets positive and moving and allow them to expand. And that's the point where I think they get quite interesting, because there is the risk of building a new mine, but you can get a gold miner that might be going from 80,000 ounces a year, 100,000 ounces a year to 150, 200 and above for quite cheap at the moment. So there's a few options in there as well.
As you say, there are a variety of companies highlighted in the piece. We do also talk about another metal we haven't had time to touch on, aluminium, as an alternative to copper. So worth picking up a copy of the magazine or having a look online if that has whetted your appetite. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to move on now, though. We're going to talk about the election. It is coming up. Manifestos, Hermione, have now pretty much all been published. Labour's admittedly only about an hour before we came on air, but given there's not much new in there, hopefully not too many surprises for you. Let's start with quite a sort of top-down view, as befits your economic status. What are the spending plans of Labour, Conservatives, Lib Dems maybe as well? How do they all sort of compare and contrast?
Well, if I start off with the Lib Dems, whose manifesto we saw first this week. So their pledging an extra £27 billion in day-to-day public spending, which is actually quite a meaningful change on current plans we've got now. So most of this would be targeted on health and education and defence, and they're hoping to fund it by tax rises that they claim will raise a very similar amount. And the most attention-grabbing of this has been some changes to capital gains, which they hope can raise over £5 billion by the end of the next Parliament. And they're also hoping to raise a lot from a clampdown on tax evasion. If we move to the Conservatives next, their most headline-grabbing plan was to deliver another 2p cut to national insurance. And this is part of their longer-term plan, where they're saying they hope to abolish national insurance entirely because they see it as an unfair double tax on work. This tax cut would be partially funded by some changes to the welfare system and, again, another clampdown on tax avoidance. They also had a new package to support people who'd like to own their own home, so they want to permanently abolish stamp duty for first-time buyers on homes up to the value of $425,000 and introduce a new Help to Buy scheme. According to their manifesto costings, there would be a cost to the Exchequer over the next year, but in subsequent years they say that the impact would be positive, meaning that they'll actually reduce borrowing by £2 billion over the Parliament, and they were very keen to stress that this was a prudent and fully costed programme. And then hot off the press, we've had the Labour manifesto this morning. There weren't too many surprises. They revealed plans to increase NHS spending, increase childcare provision, and launch new Great British Energy, which is going to be a publicly owned clean energy company. They're hoping to fund this by, again, cracking down on tax evasions, some changes to tax on private schools, and a windfall tax on oil and gas firms. They reinforced a pledge not to increase income tax, VAT or national insurance should it win the general election next month. They've also said that they're going to stick to fiscal rules that actually look very similar to what the Conservatives have got in place. There are a couple of interesting things that weren't announced in the Labour Party manifesto that there was some speculation about that it might as well just kind of go over now. One of these was the idea of tiering the interest paid on reserves that commercial banks hold at the Bank of England. An economist had calculated that this could save the public sector billions of pounds a year, depending on how we fix the reserve requirements. She highlighted the dangers of doing that. They also didn't announce any changes to capital gains tax, but they did refuse to rule out making changes later on. And in the press conference afterwards, Starmer did rather sidestep a question about whether he could calm voters' concerns that he might kind of introduce new plans once he was in power.
We'll come to CGT in just a moment. It's interesting, isn't it, the focus of the tax-raising plans for both the Tories and the Labour. A lot of it is pinned on tax evasion, which every budget you get, we're going to raise this much by cracking down on tax evasion. And I think if you compare those plans versus how much extra revenue these measures actually bring in, there's going to be quite a big gap there, which maybe does really just reinforce the overall point, which is that there are tax rises, A, hidden in plain sight here in some cases, and B, probably more to come, whoever's in power, than are being outlined in the manifesto.
I mean, I think it's really easy to be cynical about this tax avoidance stuff because if it's so easy, I mean, surely the government, who's been in a fiscal pinch for years now, would have done it already. As you said, there was some very interesting research from the Resolution Foundation think tank, and that basically highlighted that even though we have got some material differences between what Labour and the Conservatives are proposing on tax, this will actually be dwarfed by the tax rises that have already been announced by the government and that Labour have basically implicitly said that they're going to stick to. So this is things like freezing the income tax and national insurance thresholds. And then we've got increases penciled in to fuel duty and stamp duty and business rates. And this is expected to increase taxes by over £20 billion a year by the end of the Parliament. When you take these into account, there are some really big tax increases basically hiding in plain sight.
Let's talk about CGT. There's one of two reasons to flag the Lib Dem manifesto. The first, because who knows, at current rates, there could be the official opposition by it next month. Strange as such things may have sounded just a few weeks ago. But secondly, because of their CGT plan, which has been picked up in the context of Labour as well. As you say, Labour have not been ruling out doing something similar. The Lib Dems effectively want to equalise CGT with income tax rates. So the highest rate of CGT currently of 28% or so would rise to quite a bit higher than that, 45%. And they do have a couple of mitigating factors, which are quite interesting in themselves. One of which is a slight rise in the CGT tax-free allowance, albeit only from the current 3K to 5K, which is still less than the £6,000 it was before April. The more interesting part is the fact they suggest some inflation linkage could come back. Now, that was always something which used to apply to capital gains, and I know various people have called for that to return. albeit there is no detail there. The point, though, is that whether Labour will follow suit. I mean, as we've already outlined, it does seem like something they may introduce, assuming, as we pretty much all do now, that they will be in government as of next month. So it might be something coming down the track in the months ahead.
Yeah, I mean, economists have calculated that you could actually raise a huge amount from equalising income tax and capital gains tax rates. So almost £17 billion a year if you don't index the gains for inflation. And as you said, the reason that the Lib Dems are planning, well, hoping to kind of raise a lot less than that figure is because they're going to introduce, or have pledged to introduce if they get into power, a new inflation allowance. And this basically means that any gains that result from inflation are not taxed. And they said that most people are paying far too much when they sell a property or a few shares because the system doesn't account for inflation over the time that they've owned them. And they've said that the proposal is really designed to target super wealthy people who use the existing capital gains system to avoid paying rates of income tax that everyone else does.
I should say, actually, I realised an error I just made. The highest rate of CGT currently is 24, not 28%. So that rise is even larger. You're nodding knowingly there rather than you politely refrained to correct me, but I eventually got there. Let's talk about ISAs as well while we're on the realm of speculation, because CGT might be something coming. You mentioned the Resolution Foundation. Their chief executive, I'm not sure if he's chief exec, he's certainly the head of the foundation publicly, Torsten Bell, is standing as a Labour candidate in what I assume is a fairly safe seat, given most of them will be for Labour this time round. And the Resolution Foundation has previously suggested a restriction of ISA allowances would be a good idea. There's no suggestion that this is Labour Party policy, but given he will be in the party soon, and who knows, given his background, might have a role to play on the finance side. That's something that's got people muttering as well. So we are firmly in speculation territory here, but maybe that's something to look at too.
This is, again, speculation territory, but the Resolution Foundation have been quite critical of ISAs before, so basically criticising them for being well-intentioned, so, encouraging savings is a laudable aim, but quite badly targeted because they tend to encourage saving amongst the richer parts of the population and actually quite expensive. They've also been very critical of evidence about them actually increasing savings rates. So noting that when we have increased the ISA allowance in the past, it didn't actually have a very big impact on aggregate household saving. So yeah, I definitely think that as an organisation, they are quite critical of ISAs and the role that they play.
Let's talk about interest rates to wrap things up. Not too much moving the dial, it seems like, currently in terms of fiscal plans. So therefore, is it fair to say there shouldn't be too much change in the Bank of England's thinking? Obviously, it doesn't want to be political in any case, but in terms of how much spending it's expecting to come down the line and therefore how much economic growth it's expecting and what that might do to its considerations over when to cut interest rates.
I think that's fair to say, but I think it's also worth stressing that you wouldn't think that listening to how the two main parties are talking about each other. So just over the past week, we've seen Labour releasing costings saying that the Conservatives risk increasing interest rates, and then Sunak has insisted that the Tories are the party to back for low interest rates. It's worth stressing that the government actually can't impact interest rates. The Bank of England is operationally independent, but they can indirectly impact interest rates. And as you say, huge spending plans could inject a lot more demand into the economy, which could increase inflationary pressures. And then there's also the risk of kind of unfunded spending plans spooking markets like we saw after Liz Truss's mini budget, where basically borrowers demanded a premium if they were going to lend to the UK government. And I think thanks to fiscal rules, neither of these scenarios do look like a serious risk today. Conservatives and Labour have pledged to stick to their fully costed and fully funded manifestos. So I think that should limit the scope for an inflation surprise.
We will obviously be keeping a close eye on this, as everyone will over the next few weeks and after the election too. I think it is fair to say, though, given the revenue requirements perhaps to do everything Labour is hoping to do, or certainly that many of their voters will hope they will do, that there may be more tax rises on the way. They do have a few suggestions on this front, don't they, in terms of closing the carried interest tax loophole for private equity, also in terms of looking at how to end the use of offshore trusts to avoid inheritance tax. So that is one tax evasion aspect they have specified they will raise a bit more from, but it does seem like they might need some other things to really move the dial a bit more further down the line. So we'll be keeping a close eye on that in the weeks and months ahead.
I would also say that they've also, in their manifesto, said that they're going to commit to a single fiscal event a year. So there will be only one kind of big budgetary announcement, presumably going ahead with Labour, which they say should increase certainty for families and businesses and mean less for economics writers to cover, I imagine, as well. Yeah.
Well, whoever was Chancellor then, it's been hard to keep up Didn't they try and scrap the autumn statement a few years ago, maybe, and have one event there too? Events rather got ahead of them there, so we'll see if Labour can stick to that as well. We've got to move on, though. We're going to our final segment now, talking about Halma. As I mentioned, the top full-year results out today. Very well received by the market. Market's a safety equipment manufacturer, isn't it? As I mentioned earlier on, it has a few strings to its bow, though. But let's start by talking about the figures and what it's been doing well. It's always been well known as a dividend payer, 45 years of consecutive dividend increases now, a quality company. The growth, as I mentioned before, also seems to be coming through at the moment too.
Well, the results have been covered this morning by our colleague Arthur Sands, and I've just been having a quick thumb through as well. As you mentioned before, it is a really well-covered stock, always trades within a fairly narrow band as well, and has a lot of institutional support. And it doesn't really have any ESG concerns as well, given the nature of its business. So to look at today's results, we had revenue eclipsing the £2 billion mark for the first time, while adjusted profit increased by about 7% on a constant currency basis. More importantly, the related underlying margin improved by about 40 basis points too. That was significant given that last year there was some pressure on margins too. So the management will certainly be pleased with that. Having said that, one of the real attractions of the stock as well is that the metrics don't really change that much over the long term. Progress has tended to be incremental, but significant. As you say, it's a dividend stock too, and they felt able to increase that by 7% to 13.2p a share. That's because the cash conversion rate was very good this time around, and it's always been a good generator of free cash flow, a point that Arthur makes in his analysis too. I guess the real story that came through was the contribution from the acquisitions. It's interesting, the structure of the company as well, because it has dozens and dozens of subsidiaries across the globe, and there's a high degree of independence in terms of the way that they're set up as well, which can be problematic for a time if you're sort of engaging in M&A consistently. And over the past 5 years, I think it is, well, actually, over the last 2 years, the group has spent more on acquisitions than it did in the previous 5 too. And that can become a problem in terms of supporting margins. So that underlying trading margin increase today would have been well received, certainly. And there's continued high rates of return as well, because the return on sales is just under 20%, which is in keeping with the long-term average too. The R&D investment was up during the period. There's also, according to management, a decent pipeline in terms of potential acquisitions. The balance sheet's in pretty good nick, so we can probably look forward to some more activity on that score. So I would say, looking at it, the most favourable aspects of the report today was that increase in the underlying trading margin, the cash conversion rate, although we've become accustomed to that being pretty good down through the years.
Yeah, you mentioned they trade in a tight band, but I believe you were saying that partly to sort of reference they're not a stock where you get too many surprises from, but nonetheless they are up 10% today, and clearly the long-term track record is really stellar as well. One thing I should mention on the dividend front, despite the increases that come every year, the yield is still, I think, sub 1%. So you're not getting a big amount to begin with, but you will be pretty much guaranteed it can keep growing each year, which is just as important half the time. Let's talk about some of the divisions, because maybe we can go into a bit more detail about what it does. I mean, Halma has 3 main divisions, doesn't it? It's focused on safety equipment. It also looks at environmental and analysis is another arm looking to help companies with those things, and also healthcare too. And then there's the regional breakdown too. And something that struck me from these results was that the UK is starting to do a bit better overall. Organic growth quite a bit stronger than it was in the previous year. We spoke about the company about a year ago today on the podcast from its previous results, which were also pretty good. But how did that sort of breakdown strike you? Anything catch your eye there in terms of the respective divisions and the respective geographies, Mark?
I think the only division which underperformed, if that's the right term, was the healthcare section through there. But otherwise, the growth was pretty good in the other two as well. I think I made the point to you prior to the podcast that this is quite an interesting year for Halma because of prospective political change. And I was thinking in terms of the UK here, but actually, given the fact they generate more revenue in the US than they do in the UK and continental Europe combined, the election come November there could be interesting. You would imagine, for instance, that an incoming Trump administration wouldn't be quite as hard line in terms of on the regulatory front. But by the same token, a lot of the revenue that's being generated around the world, and in the US in particular, is linked to infrastructure, specifically creaking infrastructure. And so that is positive for trading patterns going forward. I guess it's ironic in a sense as well, because we're approaching, or we may have just passed the anniversary of the Grenfell disaster too, and I received some interesting posts this week from the fire trade union as well, and they've been calling on Labour to end what they term the crime of deregulation. And in general terms, I would say that Halma is one of those stocks that benefits from regulation complexity. There's plenty, say, within the financial services sector that fall within that category, but it's an interesting aspect for our readership and our listeners to take on board too. So, according to the Labour Party's Green Paper on employment rights, the health and safety executive and local authorities have seen their budgets been halved over the past decade. So Labour plans to overhaul enforcement practices for health and safety regulations, again, which is positive for the business case going forward. Although, as Hermione just mentioned as well, promises might grind up against sort of fiscal reality.
Yeah, the three arms to the business, the safety business, which is about 40% of revenue, or it was last year, that does have various applications such as fire detection, suppression, things like that. So there is some relevance in that specific area too. Healthcare, maybe a bit less tied into regulation and more about the equipment needed to monitor and accurately work out what's going on with people is my medical definition of what they do there, rather broadly. But the environmental analysis side is an area as well where you may expect more regulation to be beneficial. It was interesting in the results to look at one line in this regard, where they talk about, as I say, better prospects, better efforts in the UK, but they do say there was only modest growth in the UK environmental and analysis sector, given lower order intake from UK utilities in water analysis and treatment. You would have expected a higher order intake, I would say, given all the controversies over water treatment and the state of our waters. So maybe that's something we can expect more demand from in future too.
Yeah, that's certainly counterintuitive, but it could be just timing efforts on that too. And I'm not sure to the degree to which, say, the water industry outsources in terms of the problems they're facing at the moment. But obviously, Halma would be front and center if that does increase.
Maybe they should start outsourcing. We will see. It maybe all change for a number of industries in the months and years ahead. Thank you, Mark. That does bring us to the end of today's show, though, because we have unfortunately run out of time. So thank you to Mark, to Hermione, to Alex, to our producer, Maddie Apthorpe, and thanks to you for listening. We'll be back next time with another Companies and Markets show.